Generally speaking, I'm quite active with my investment approach, and what I mean by this is that I won't hesitate to sell positions as they reach their fair value to reinvest elsewhere. I'm still long-term oriented, but if the thesis has already played out and the future upside is limited, I would much rather sell and switch to something else with more upside potential. This explains why quite often I end up holding some specific REITs for only a year or two. But that's not always the case. There are some specific REITs that I expect to hold for a very long time to come because I think that their business models will create significant shareholder value over time. Hey, this is Jussi. I run a small investment firm that specializes in REIT investing. In today's video, I'm going to discuss 5 REITs that I expect to hold over the next decade. But before I get into it, I want to remind you that we're still offering a 2-week free trial for our REIT newsletter. I think that this is the last week we're still offering it. So if you want to access my full portfolio, my trade alerts in real time, and all our research, including many REIT CEO interviews, we just posted one recently with the CEO of YCHARTS Properties as an example. Now is the last chance to take advantage of this 2-week free trial. It will be the first link in the description of this video. So the first REIT I'm going to discuss here is called First Industrial. Its ticker symbol is FR, and this is probably my favorite industrial REIT investment opportunity. It owns mostly Class A distribution and logistics centers in infill locations of strong supply-constrained coastal markets. I really like these properties because the demand for them is growing consistently because of the growing trends of e-commerce as well as onshoring. But despite the growing demand, the supply is quite limited because these are properties that are in infill locations of strong and growing markets. And so these locations are already built out. These are quite urban. There just isn't more space to build new additional properties. I think that this creates an attractive supply-demand dynamic that will result in significant rent growth over the long run. But that's not even the main reason why I'm investing in First Industrial. There are 2 other reasons why I expect the company to create significant shareholder value over the next decade. Firstly, its current lease rates are deeply below market, and this is simply because market rents grew a lot faster than the escalations that it had in its leases, and so its lease rates fell far below market, and this provides an opportunity for the REIT to now significantly bump up rents as its leases gradually expire. Last year, its releasing spreads were nearly 60% on expiring leases. This year, they've been somewhat lower at 40 to 50%, and that's what we expect also going forward as most of its leases expire over the next 3 to 4 years. I really like this because it provides a bank of growth that the REIT essentially has already secured, and now it just has to roll over its leases with the higher rates, and this will create significant value for shareholders. The second REIT that I really like about this REIT is that it owns a significant land bank, and it's estimated to be worth about $1 billion, which is very significant for a REIT with a $7 billion market cap. Historically, First Industrial has been very successful at developing new properties, typically with an initial yield of around 7%, which represents a roughly 200 basis point spread over its cost of capital, and I expect the REIT to develop a lot of this land over the coming decade, resulting in significant value creation. So when you now combine all of this together, the growth in market rents, but also closing the gap between the lease rates and market rates, which we already have, and then developing this land bank, I think that the REIT is in a strong position to grow its cash flow on a per share basis at a high single-digit growth rate or even a low double-digit growth rate going forward. Now add to that the 3% dividend yield, and you're set to earn roughly 10 to 12% annual total return simply from the yield and the growth of the company. But that's not all. I also think that the REIT is today undervalued, just like most other REITs after going through this 2-year-long bear market. But as now interest rates return to lower levels, we've already seen REITs start to recover, and I think that this will continue over the coming 12 to 24 months. If you now expect the REIT to price at a somewhat higher multiple, not quite as high as its peak when interest rates were at near zero, but if you expect it to expand somewhat, perhaps halfway to where it was at its peak, this would unlock about 30% upside from here. Now you add this upside from multiple expansion to the dividend yield and the growth of the company, and you can expect to earn over 15% average annual total returns over the coming decade. That's extremely attractive in my opinion, coming from such a defensive, high-quality REIT that has Class A properties, an exceptional track record, a very strong balance sheet as well with low leverage and a 25% LTV. So in terms of risk to reward, it's hard to find better than First Industrial, and this is why I expect to hold it for a long time to come. The second company on today's list is called RCI Hospitality. Its ticker symbol is RICK. RCI is not officially structured as a REIT, but it essentially functions as one, and it's focusing on adult nightclub property investments, and the thesis is pretty simple here. It really comes down to the fact that there are very few buyers for these assets, but there are many sellers. There are few buyers because these clubs require highly specialized expertise, and there's also the social stigma of investing in these clubs, especially the ones that REIT is targeting, which are close, to gentlemen's clubs, strip clubs. If you're a successful business owner, probably your wife or your husband doesn't want you to buy the local strip club. And similarly, if you're running a small private equity fund, probably you have some limited partners who don't want you to invest in this space. And so because of all of this, there just aren't many buyers for these assets. But there are many sellers because today most club owners are approaching retirement age, and this is not typically the type of assets that you pass on as legacy to the next generation. So there are few buyers but many sellers, and as a result the valuation multiples for these businesses are typically very low at just 3 to 4 times EBITDA, sometimes 5 times EBITDA for the very best clubs. But despite these very low multiples, these are quite attractive businesses when you think of it, because they are essentially quasi-monopolies in their local markets, because you need a license to operate these businesses, and today it's almost impossible to get a new license since nobody wants a new strip club in their backyard. And these are high margin businesses as well. It's relatively recession resistant. Many people think that they're highly cyclical, but they really aren't if you look at the past performance of these clubs during most recessions, because people typically tend to drink even more during recessions. They still want an escape from their stress, which may go up during a recession. But the point here is that these are relatively attractive businesses. They're not exceptional, but they're relatively attractive, and yet you can buy them at very low multiples. And RCI happens to be the only company in this space with significant scale and access to public capital thanks to its public listing, and this puts it in a very strong position to consolidate this fragmented sector, earning significant spreads over its cost of capital. Typically, REITs like Realty Income, Vichy Properties and others are happy if they're able to earn a roughly 150 basis point spread over the cost of capital. If they're getting more than that, let's say 200, 250 basis point, that's exceptional for them. And yet the REIT is doing far more than that. Its spreads are closer to 1,000, 1,500 basis points because its cost of capital is about, let's say, 10%. It's acquiring the clubs at a 25, 30% cash flow yield, and the spreads are just enormous. Since starting to pursue this acquisition strategy, RCI has managed to grow its free cash flow on a per share basis by roughly 20% annually. And this has also resulted in huge returns to shareholders. As you'll see in the table I'll put on the screen, you'll see that it has massively outperformed most other stocks, including also the S&P 500 index. However, over the past 2 years, the stock of the company has crashed along with the REIT market, and then some, because it's a relatively small company. It's focusing on a sector that's perceived to be a lot riskier, and the company also suffered a few setbacks. The main one that appears to have hurt its market sentiment is that in the post-COVID period, we had a lot of bumpiness in the performance of the clubs. At first, when the world reopened in 2021, 2022, everybody was going to the clubs. They were spending a lot of money. Interest rates were low, people were getting stimulus checks, and so naturally the clubs were doing exceptionally well. But this exceptional performance wasn't sustainable, and we saw that then in 2023, 2024, which we've called the post-COVID normalization period, where we saw the comps of the clubs come back down to more normal levels, but this resulted in having negative comps compared to those previous years, and the market didn't like this. However, now the performance of these clubs appears to be normalizing, and yet the company is trading at just around 7 to 8 times its free cash flow, and I think that this bodes really well for the company over the coming decade as it restarts to acquire more clubs to grow its FFO per share. I think that there's real potential here to earn 20% plus annual total returns over the coming decade here as the company consolidates this fragmented space, earns significant spreads over its cost of capital, resulting in significant growth in its free cash flow. And on top of that, the multiple of the company expands a bit as the company becomes bigger and better diversified and better communicates its story. But naturally, you don't earn this type of returns without taking some risks. This sector is much more cyclical. The company is smaller in size. There's no doubt that this is riskier than First Industrial, but the future potential returns are also greater. Hey, before I go into the third company, can you please do me a huge favor and click the like button if you think that this content is valuable? That will help me a lot to keep growing this channel. Thanks so much in advance. So the third company I'm going to discuss here is called Vesta REIT, ticker symbol of VTMX. And this is the only Mexican REIT that I invest in today. It's also the only Mexican REIT that's listed on the New York Stock Exchange. And this listing actually gives it a competitive advantage because it's able to access American capital at a lower cost to then reinvest in the Mexican market where returns are typically higher. And I think that right now is a great time to invest in the company, especially if you're long-term oriented and you're looking at the next decade, because, there's this growing trend of nearshoring now. Increasingly, many companies are bringing back portions or even entire supply chains from China back to the US or to Mexico, and especially Mexico, because their labor cost is way cheaper than in China these days. If you put your supply chain in Mexico, it's also much closer to your end customer if you're an American, a Canadian, or even a European company. And then thirdly, we've learned perhaps over the past few years that these dictatorships like China cannot be trusted because, China is today collaborating with Russia, helping it in its invasion of Ukraine. It's working hands in hands with companies like North Korea. They are themselves threatening to invade Taiwan. And so a lot of Western global companies are feeling a bit uneasy about this and now reconfiguring their supply chains. And this is greatly benefiting Mexico. It's leading to significant demand growth for industrial space in Mexico, and Vesta is here to provide it. It already owns a large portfolio and expects it to enjoy strong rent growth over the coming decade, but importantly, it's also developing new properties, and it's able to earn very high initial yields on its properties. Historically, that has been in excess of 10%, yet, as I mentioned earlier, it's able to access relatively cheap capital in the US. Today, its average interest rate is below 5%, so the initial yields on its new development projects is double its interest rates. Even if interest rates expanded from here, it's still able to earn very large spreads, much larger than those of your typical American REITs, and therefore expect its growth to remain very strong over the coming years. This year, the company has guided to grow its FFO per share by about 10%. I think that they can keep this going for a long time to come. This will lead to significant value creation, and yet the REIT today is priced at just around 13 times FFO, which is much lower than your typical American REIT. And so if you combine now the low valuation with the rapid growth, I think you're well positioned to earn very strong returns here, potentially of 15 to 20% annually over the next decade. But again, here, just like in the case of RCI Hospitality, there are greater risks here. You're investing in Mexico. This is a riskier market than investing in strong coastal markets in the US, as an example. But again, you're getting rewarded for taking this risk. The company's run really well. It has relatively low leverage, high quality assets, and now it just has to keep replicating its strategy to create value for shareholders over the long run. Then the fourth company on this list is WP Carey, ticker symbol WPC. And here the story is not so much about the growth of the REIT. I expect it to grow, but I don't think that its growth will be anywhere close to these REITs that I mentioned earlier. However, the story here is much more about its transformation and how I expect this to eventually impact its market sentiment and lead to a higher valuation multiple. If you think of WP Carey, historically this has been a diversified net lease REIT with a bit more leverage than its peers, a high payout ratio, too high to my taste because this has prevented it from retaining cash flow to reinvest in growth, quite a bit of exposure to the office space as well. Then it also had an asset management business that was earning fee income. And so overall the market wasn't too pleased with it. It wasn't able to grow its cash flow for many years because it was gradually looking to exit the asset management business, it was looking to exit the office sector as well. As I mentioned earlier, it wasn't retaining enough cash flow to organically reinvest in growth. And so it was stuck in this phase of no growth for many years, and this hurt its market sentiment. But the management finally had enough of this and did something about it. They took the drastic decision of spinning off their office properties into a different REIT. They used some of these proceeds to pay off some debt, to reduce leverage. They also used this as an opportunity to lower their payout ratio, now to retain more cash flow to reinvest in growth. And they've also now almost fully exited the asset management business. And so now when you today think of WP Carey, it's a much higher quality REIT. It's primarily focused on industrial net lease properties with no exposure to offices. It doesn't have the overhang of having to exit the asset management business or office properties. It has a lower payout ratio, allowing it to reinvest organically in growth. It has lower leverage. So overall, the REIT is really well positioned now. It's better positioned than ever to start growing from here. And yet the REIT is today priced at one of its lowest valuations in history at just around 12 times FFO. This is likely because the decision of cutting the dividend naturally wasn't very popular, especially among income investors who felt betrayed by the management in a way. But I think that they will forget about this in the coming years, and this will lead to a strong recovery in the valuation of the company. This greatly reminds me of Agri Realty, which is another net lease REIT that cut its dividend in 2011. Back then, the company was hated, its share price crashed. However, over the next decade, this was actually the most rewarding net lease REIT in the market, as is it rebuilt from a lower base, from its low valuation, it regained a higher valuation multiple, even as it grew its cash flow at the same time. And I think that we are likely to see something similar with WP Carey now over the next decade. Right now it's hated, but eventually the disgruntled income investors will be replaced by other more growth-focused investors. They will realize that what's in the past is in the past, and what matters now is how the company will do in the future. And eventually expect the REIT to reprice it closer to 16 to 18 times FFO, which is much more reasonable for an industrial net lease REIT. And this would unlock about 30 to 40% upside from here, maybe slightly more even. While you wait, you're earning a 6% dividend yield. It's one of the highest yield levels in the net lease sector today. One of the highest yield also for an investment grade rated REIT in the entire market. I also expect the REIT to grow its cash flow by about 4% annually. So just between the yield and the growth, you're getting to roughly double-digit total returns. Add the upside on top of it. I think that you might be in a position here to earn roughly 15% average annual total returns over the coming many years. And again, that's not as much as RCI or Vesta REIT, but it's very attractive coming from an investment grade rated blue chip like REIT in the US. Now, before I go into the last company of this list, I also want to remind you that we have a free section to our REIT newsletter, High Yield Landlord. There's a bunch of high quality free research there. Please check out the second link in the description of this video. The final company of this list is New Lake Capital Partners, ticker symbol NLCP. This is again a bit of a riskier company because this is a micro cap rate. It's very small in size. It's focusing on a riskier segment of the commercial real estate market, which is that of cannabis cultivation facilities. However, with higher risk comes higher potential returns, and I think that New Lake is in a really strong position to deliver strong returns to shareholders over the coming years because it combines three things: a high dividend yield, rapid growth prospects, as well as the potential for multiple expansion. And so, starting with the yield, the dividend yield today is about 9%. They've been able to grow their dividend in nearly every quarter since going public, which is really remarkable for such a high yielder. The payout ratio today is still very low at around 82%, so the dividend is safe. Now, talking about the growth, I think that the REIT is in a position to grow at a rapid pace for a high yielder. And by rapid pace, I mean mean to high single digits, so 5 to 7, 8% perhaps per year. And how will they achieve this? It's in a few ways. First of all, they have 3% annual rent escalations in their leases. Secondly, the REIT is retaining a lot of cash flow, as I mentioned earlier, about 20% of its cash flow to reinvest in growth. And this actually moves the needle for them because they are small in size. They are getting very high cap rates in this sector, cap rates of about 12% or more. So this really moves the needle and actually results in growth. And the third and most important thing here is that today the company has no leverage at all. And what this means is that the company could significantly expand the size of the portfolio now by adding some leverage to the balance sheet, buying more properties, and they will be able to buy them at very large spreads over relative to the interest rates of their debt, resulting in significant growth on a per share basis. Okay, so they're paying a high dividend yield, they have solid growth prospects, and now let's talk about the potential for multiple expansion as well. You know, today they are priced at just 9 times FFO, yet their close peer Innovative Industrial Properties Trust is priced at closer to 13, 14 times FFO, so that's a significant spread, and that's despite them actually having a weaker balance sheet. They have some leverage on it. I think that their properties on average are also of lower quality. They have faced more tenant issues in recent years, and yet they are priced at this premium, I think not because of fundamental reasons, but simply because they have a superior listing. Innovative Industrial Properties is listed on the New York Stock Exchange. They came public during a time when it was possible to list on the New York Stock Exchange as a cannabis REIT. They took advantage of a window of opportunity there. But when New Lake came public, it wasn't possible anymore. And so they are just OTC listed. And this weaker listing, I think, is reducing the demand for their shares, especially from institutional investors who require a better listing than this. And it's causing its valuation to be depressed. But I think that sometime over the next decade, perhaps much closer to the beginning of this decade than the end, we'll see rules changed again, and eventually New Lake will be able to seek a better listing, and this will lead to some multiple expansion as more capital is pushed into this sector. If you want to learn more about New Lake Capital Partners, we have an exclusive interview of their CEO at High Yield Landlord. Again, there's a 2-week free trial in the description of this video. So that's all. These are 5 REITs that I expect to hold for the next decade. Now let me know in the comment section below what REITs you're investing in for the long run. I'll be happy to discuss with you. If you could please click the like button, subscribe to the channel, that will help me a lot. Thanks so much and see you at my next one. Bye bye.